And our other co-organizer, Alex, is in the Zoom chat and he is monitoring everything. If you guys can have a seat, we're about to get started. And I'm just gonna pass it off to my co-host, Chris, here so that he can do intros. One last thing is there are snacks and pinwheels over there and there are drinks all along that wall. So let's support this wonderful business by buying a drink.
Got this.
All right, everybody, another round of applause for the first annual GOB conference. Welcome, everybody. And for those of you guys who are joining us virtually, thank you for coming. We're very excited to have you here as well. So before we begin, let's also give another round of applause for Eric Swanson over here, the most accommodating venue host, fellow real estate investor. And we have a full day of great content coming up for you guys. So make sure you guys do us all a favor and keep your glasses full. With that being said, my name is Chris Tribio, co-founder of Windy City REI, and I'm also the managing partner of Greystone Collaborative. Just wanted to introduce myself to you guys. We're a private equity firm. We currently hold about $1.5 million in real estate and small multifamily. We've generated about $380,000 in forced appreciation over the past 18 months. And we're looking to scale into larger multifamily properties and provide value to those of you who have experience. So if those of you guys who don't know who we are yet, please reach out to us. Today is a great day to network. We'd love to meet you guys and see how we can provide value to you. So with that being said, we're going to call up on our first guest over here today, the man of the hour, Jim Biggs. Yay. Yeah, I'll get you mic over here.
Just hang on to that.
Pocket.
Cool.
There you go.
All right, thank you very much, Eric, for hosting us today. We really appreciate it. Thank you, everyone, for showing up. Very excited about making this our first annual GOB conference. We'll have another one that we're going to start working on after this weekend. Okay. And as you can tell, I'm very intimidated by this. So usually do not mind speaking in front of a crowd, but knowing that I have to pay attention to the microphone and the other stuff. So anyway, past my nervousness, as you guys know, I'm an introvert, so I'll power through this and put on my extrovert shirt and we'll get started. I really want to just spend a little bit of time talking about what the GOB network is, why we started it and where it came from. And basically, I can tell you that it came from both frustration and failure. But had it not been for COVID, we would not be here today. And we've had some conversations here amongst ourselves today about the benefits and the things that have happened over the last year. One thing that we know when we have these big major disruptions is that a lot of new disruptive companies come from that. And we definitely are in hopes that the GOB network is one of those companies that we're trying through the power of the crowd to make sure that we build something here that doesn't depend on any one person or even a couple of different people. The leadership and ownership of this organization belongs to each and every one of you, each and every person that decides to become a member of the GOB network. And with that, we should ensure, as long as we remain engaged, that it lasts long after we're gone. And that's my hope for the network. And I will do everything as long as I'm here. I'm 63. Hopefully, I've got another 40 years left. And we'll continue building this network for as long as we can. But it really will not grow just with me. You know, I've been able to grow a small network of people over a period of the last 6 months. But when we grow as a crowd, when each one of us take ownership of that, and we bring several of our friends, 3 or 4 or 5 people that we know into the network, and they do the same thing, we will grow exponentially. And we will become what I hope is such a disruptive energy in the space. So going back over my 40 years of interest in real estate, I've told the story many times, that I've had a lot of coaches, I've had a lot of gurus that I have paid a lot of money to teach me how to do what it was I wanted to do. And each time I did that, I was trying to go bigger, faster. And it's not that they didn't help me, they did. I wouldn't be here today had it not been for all the coaching that I've received. But my frustration with each of those organizations, each of those people, was that I never felt like I really received the return on investment that I wanted. And I honestly thought they were leaving a lot on the table. I thought they had a broken business plan. I thought they were, quite honestly, not that bright. You know, I thought they were ignoring most of the money in the room. And you guys have heard me say that, you know, the first thing that you hear in a lot of these really big events is that 80% of you are not going to join us on this journey. 80% of you are going to decide this isn't for you. And that's okay, because we're only looking for the 20% go-getters that understand what we're trying to do. And I always thought that was stupid. I always thought that you just told 80% of the people in the room with 80% of their net worth and their liquidity that you weren't interested in doing business with them. And so we wanted to concentrate on that 80%. But even more than that, as we have started to grow, I've realized that even the people in the 20% that sign up and go through these programs, 80% of them fail. 80% of them never actually accomplish what they set out to, which is to buy an apartment building or partner with somebody else to buy an apartment building. And that to me was unacceptable. And that's what we want to concentrate on. We want to concentrate on changing that paradigm. And I can't do it, but collectively we can do it. Collectively, each one of us can help somebody else overcome what's unique to them, what their unique problem is. And I was talking to, is it David? Ben, earlier this morning about how we do this. That, you know, and he made the comment that, you know, rich people buy these apartment buildings. Well, most of them, it's not rich people. It's a room full of very average people like we have here today. And collectively, you know, we buy these large commercial assets. And that's what we want to teach people to do. We want to teach them that you don't have to be extraordinary. You don't have to be filthy rich. You just have to have a desire that you're willing to act upon. And collectively, we want to help Eric, who owns this establishment, buy this building. And I committed to him before I came up here this afternoon that if he was interested in buying this building, that I wanted to help him buy it. And that collectively, I want the Windy City REI to help him buy it. And collectively, I want the GOB network to help him buy it. And that is the essence of what I want this network to be. Now, that's my personal goal for the GOB network, but it may not be the ultimate goal of the GOB network, because it needs to be very personal to each and every one of you. The network needs to belong to you. You need to take ownership of the network. And that's why we have chosen that three-legged stool model of, number one, it's a freemium model. If you think of Google, you get Gmail and Google Sheets and Google Docs and all of these tools for free. But they charge as you learn and grow for access to bigger things. But you can do just about anything you want to do with the free model. And so that is the foundational piece of the GOB network, is to provide you with tools and resources, the things that most of these gurus are charging you 30, 50, even 100 grand for, and provide you with what they don't provide, which is deep knowledge of the membership that is in that organization. And the other piece of it is we want to use the hive mind. We want to become the Wikipedia of commercial real estate. And what I mean by that is, with the input of everyone that's listening to this today, we have a hive brain that can solve any problem. I can't, but collectively we can. And then the last piece of it is, I wanted it to be open source. So I want you to have access to build everything in this network to make it as much and as best it can be. Very similar to the tech industry. The Linux operating system was built upon an open source program. And it had not a chance in hell when it started some 40 years ago. It had to go up against the Microsofts of the world, and it did not stand a chance. You know, just like Wikipedia, you know, they thought didn't stand a chance. We've got 100, 1,000 professional writers that are building World Book Encyclopedia. But almost overnight, collectively, you had millions of people that were putting their energy into the largest repository of knowledge in the history of mankind. And we can do that collectively with real estate. And we can build the greatest underwriting model that's ever existed. We can build the greatest capital raising platform that's ever existed. But we have to do it collectively, and we have to do it by participating. And that is really the cost of being a member of the GOB network. Number one, it is a closed membership. To get in, you have to know somebody who's in, who gives you an invitation. And then the other factor is you have to be willing to participate. And that participation is going to look like a lot of different things as we move forward. You know, for some people, they're going to want instant access. And if you want instant access to everything, then we're going to charge for that. But if you're willing to be an active participant, everything that we're doing will not cost you a dime to participate other than your time and energy. And you can gain access to everything that we're doing. And so that is the journey that we're on, and that I really am very, very grateful that we've gotten where we are with the help of everyone that's in this room. And I really, really, really appreciate it. And with that, I want to kind of open up for any questions about the network, any questions about, you know, what's there, any types of tools, because I think it would be helpful for the people that are not on the network that might be listening on some other social media channel today to get an idea. And if I try to tell you everything that's there, it'll probably take me 2 or 3 hours, and I definitely will keep talking until somebody stops me. So does anyone have a question about any aspect of what I just said?
Hi, I have a
And if
question.
you don't, I'll fill the space with talking. So
We do have one here. Ms. Meridian?
So this building that we're in today, I have no idea what it's worth. I have no idea what the square footage is. I know that it's a relatively new building. And the way that these buildings are purchased and funded is that you have one really big partner. And that's typically one of the agency lenders that are sponsored or helped by the government. That's usually Freddie Mac or Fannie Mae, sometimes HUD, and they'll bring usually 70% of the capital for you. Now you've got to qualify to get that. Like any mortgage, there's certain qualifications. And so we have within the network, we have within the room today, just within the people that are here, we have the requirements to get that loan. So you have to, number one, you have to have already done business with the agency lenders. And so I can tell you there's several of us that already have. So we have that experience under our belt. And so we meet the first qualification. So second is not only have you, do you have to have experience with them, but you have to have a certain net worth and liquidity, and combined collectively in this room, we have that. Now, typically they don't want to underwrite 50 or 100 people on the loan. They'd like to keep it down to a few, but we have the resources within the GOB network that we can take down deals, you know, anywhere. To qualify for agency debt, typically you have to start with $1 million. They don't like to do anything less than $1 million. And we can take down loans anywhere from $1 million to right now within the GOB network. If you have the biggest deal that we've worked on to date is a $50 million deal, just under $50 million deal. I don't want to work on those deals, to be quite honest with you. I really am comfortable with small deals. Most everyone in this room have never owned a commercial asset, and most of you should be looking at, in my humble opinion, much, much smaller assets. And today is not the time or space to discuss that strategy, but we definitely would be happy to get on a Zoom call and have that discussion with anybody that wants to have it. I can show you that most of the gurus out there, I'm very contrarian to what they teach in a lot of aspects. The biggest one is they tell you it takes just as much time and effort to buy a 100-unit building as it does to buy a 10-unit building. So why in the world would you waste your time on a 10-unit building? And the answer is two major factors. One is that it's exponentially harder to raise capital for a 100-unit building than it is a 10-unit. Almost anyone in this room could collectively buy a 10-unit building, either by themselves or with just a couple of friends or family members. So number one, it's achievable very, very quickly. And you don't have to raise a ton of money. One of the biggest reasons people fail, and 80% of these personal mentoring students fail, is that they spend a year trying to build a relationship to buy a 100-unit building or a 150-unit building. And they find that it's not near as easy as the gurus want you to believe to build the relationship with the brokers to get them to give you access to those properties. And upwards of 80 or 90% of all commercial properties sold are sold through brokers. So can you go direct to seller and try to find something? You absolutely can. But the fastest path to success is through brokers. And when you present yourself to a broker as a brand new investor, what reason do they have to want to do business with you? Why would they spend their time and effort with you as a brand new investor, as opposed to the 10 other investors that they've done business with for one deal, 10 deals? They know that person can execute, can close. They all know almost nothing about you. But you're dealing with an entirely different set of rules and people when you're going after a small deal, whether it's a 10-unit deal, a 5-unit deal, or even a 4-unit deal. But I would beg and plead with all of you, please, please, please start at least at 4, unless you just absolutely can't afford to. And if you can't, then let's get a strategy that gets you to 4 as quickly as possible. And I think that we can do that with anybody in the room. Heck, there's a program right here in the city of Chicago that'll give you $7,000 if you've never bought a house. Even if you work at McDonald's, you can get a HUD loan for 95% of whatever that income qualifies you for, and stack on top of it $7,000 given to you by the government. So there's no one that cannot execute on the strategy if they truly desire to do so. Now, my goal and hope for each and every one of you is to convince you to go as big as your personal income will allow you to go on your first deal. Because if you can execute on that, we can get you into something very, very quickly. And I'm really grateful for the question, because it leads into what I wanted to cover later today, and really kind of an interactive session, which is what is preventing you from taking action today? What is preventing you from owning an asset right now, today? Now, obviously, we probably don't have someone that has an asset for sale in the room right now today, but there may be, I don't know. But by today, you understand what I'm saying. There's no reason for you to wait a week. There's no reason for you to wait a month. There's definitely no reason for you to wait a year. And you need to get started. So I want to go back to the difference between a 10-unit and a 100-unit. Most people that succeed in buying that 100-unit deal, it typically takes them about a year to execute on that model. They have to first build the relationships, find the deal, go through building a team, everything that happens. The 1 to 3% that actually succeed at that typically takes them at least a year. Now you follow the other strategy that I would recommend, which is start small and grow exponentially. Start with a 4-unit. And one of the things that I absolutely agree with several of the gurus, the first deal is the hardest deal. It's the hardest one to get done. But the second one is easier. And it becomes easier each time you do it. And so if you start small on a 4-unit and turn around within 45 days to 60 days and buy an 8-unit, and then turn around in 90 days and buy a 16-unit, and turn around in another 90 days and buy a 32-unit, at the end of a year, you'll own more than a 100-unit building. At the end of the year, you'll own roughly 150 units. And not only do you have the same number of doors or greater than everyone else out there trying to do 100 units, but more importantly, you're practiced. More importantly, you have a lot of this down. You've done it multiple times. You're no longer as nervous. You know what to expect. You know what it looks like. And if you've been raising capital on some of these deals, your capital raising skills have grown exponentially. And you're much better prepared when you go from that 64 unit to 150 unit or 128 units. You're much more prepared. Now you're in a great position to succeed in taking that down. Not only the asset, but the brokers love you now. They know you execute. You've executed 4 times in a year. Every 90 days you executed. And you've learned how to raise the capital. It's not your first time. You're not as nervous. You know a lot more people now. And the people that you got to invest with you on your first deal have started telling some of their friends. And their friends have started to tell some of their friends. So you're a lot better prepared now to take down a 128 unit deal. And if you keep doing that, you'll own a lot more doors than the other strategy. It will not take you very long. Within a year, you'll be chasing those same 100 to 150 unit deals. But that first year, you're going to get to 150 by starting small and starting fast. So thank you very much for the question. I appreciate it. Anybody else have a question?
There is a question online.
Sure.
Yeah, so we have one question from online which says, can you provide a little bit more details of what you define as active participation in the GOB network?
So again, thank you very much for that question. I have some people, I'm thinking in particular of the least qualified amongst us, or at least the people that feel they're the least qualified amongst us. We have some people, some very young people on the GOB network that have never bought a house, you know, some that are still living at home. And so they don't feel they have anything to add. And that couldn't be further from the truth. It is so easy to add value to the GOB network. I'll give you the easiest way you can add value. And don't diminish what this value is. So for most of us, we understand the importance of social media. We understand the importance of using that tool to help us raise capital. And a big part of that is engagement. And all it takes to have engagement is for you to make a comment on a post that another GOB member made. So I see every day we're trying to support each other. When you hashtag any of your postings with the hashtag GOB network, then I encourage everyone on the network to go follow that hashtag and make a comment or like that comment or share it. Anyone can do that. A 12-year-old can do that. So don't tell me that you don't have something to add. You're just not thinking hard enough. Now, obviously, I give a different example. If you are an expert at designing and building websites, we just relaunched the second version of the gobnetwork.com. The first launch was one of our members built the site by himself and did a wonderful job. But when we started bringing other GOB members in to help him continue to build it out, we found that there was a knowledge limitation amongst the group. So if you're an expert at building websites, we could have really used your help over the last 6 months. And instead, we had 4 or 5 members that a few of them were experts in the space, but several of them were not. But they were willing to learn, and they were willing to lend a hand and pitch in and help us get the website up and running. So that's a much bigger commitment. That took a lot more effort. It took a lot more of their personal time, you know, but there's a million miles in between those two things. But all we're asking is, if you want to be part of this network, if you want us to help you grow, if you want us to help you take down a building like the one here that Eric is going to take down, then you need to be an active participant. Now, one of the things that we have realized, there's some people that lead such busy lives and really struggle with putting aside an hour or 2 hours a day for this. And I understand that. And if you've got the money that you want to go pay a guru, we're going to try to at least think about allowing you access to the GOB network. And you can pay for that access. But honestly, that's really not the person we're trying to help. And it would be okay with me if we never had a single person offer to pay for the site. But eventually, that's what we're going to do. Eventually, we'll get to a point where, look, if you're a brilliant brain surgeon and you're working 12, 14 hours a day, saving people's lives, and you don't want to get on social media and comment on a post, but you could give 30 grand or 50 grand to the GOB network just to get access so that you could meet the David Monroes of the GOB network. You could partner with the Jim Biggses of the GOB network or with Windy City REI. Then absolutely we want to not exclude you and give you access. But we're really trying to help the 80% that don't have that. We really, you know, most of you know I come from a very humble background, and I really do have a passion for helping people that came from places like I came from. And so that's, hopefully that answered that question. Any other questions? How are we for time, Chris?
Oh, Pat, go ahead.
Halfway through the hour.
So time for me to wrap up? So,
I think Pat had a question.
Pat,
You talked about earlier about the underwriting. I think that's a lot of people, everyone's struggle with. What is the GOB doing on that front with the underwriting deals, make it easier?
so many of the programs that I signed up for, most of them had an underwriting worksheet or template, if you will.
Can you repeat his question?
I absolutely, thank you for that, David. Yeah, so for you online that can't hear the question, Pat asked, what does the GOB network do to help you learn to underwrite, and does it offer any type of tools to help you underwrite? And so the answer to that is, yes, we do. But to give you a little background, I started to say that every program that you sign up for, that you pay for in 2021 probably has some type of tool. There are tools and also professional services out there that you can pay for to underwrite deals for you. So you don't have to be an underwriter. But I will say that the better you become at underwriting, the better investor you will be. You have to have some basic knowledge of what goes into underwriting in order to understand if you have a good deal or not. Now, I will also, many of you have heard me say that if you start small enough, it's very, very hard for you to, in the long run, mess up. It's hard for you to overpay. It's hard for you to buy a bad asset. The biggest reason people fail is not because they bought a bad asset. The biggest reason they fail is because they didn't buy an asset. And if you're thinking about buying something, let's say you're starting with a fourplex, I don't care if you overpay by 30%. If you need a partner in that deal, I'll still partner with you. Because in 5 years, it's not going to matter. Think about any deal that you could have bought over the last 5 years and how much the deals that you passed up on because you thought they were too expensive. And now ask yourself, when they came back on the market 3 to 5 years later and what they sold for, how much money you missed out on because you didn't overpay a little bit. That's the way you need to start thinking about it. Now, we know that the economy has been on a bull run for way too long compared to historical norms, and that there's probably going to be a correction coming. But the last big correction in 2008 didn't even hardly scratch multifamily. All it did was slow it down for a couple of months. And then it took a steady march to where it is today. COVID had almost no effect. It slowed down. It literally put the brakes on deals for about 6 weeks. And then it's been hotter since then than it was the previous 2 or 3 years in regard to pricing especially, and how hard it is to get a deal. So, but going back to the underwriting question, most of these programs will encourage the same thing. They'll give you a tool. They'll encourage you to learn how to use it. Unfortunately, most of them don't do a great job of teaching you how to use the tool. They don't give you a lot of hand holding and practicing. And that's probably the area that we stand out the most. Now, there are some programs out there that you guys know of that have a lot of online videos to try to help you become better at underwriting. And those are great. But even that is the exception. So what we do in difference of that is we have 2 days a week that you can practice underwriting. One of our members, Charles Seaman, has a 3-hour intensive underwriting course every single Saturday. And he will go over a new deal and put it into a worksheet and walk you through every cell in that worksheet. Why he put the number there, how he arrived at it, where the information came from. And then he uploads the videos onto the GOB network. So if you're the shy type that can't come and participate in person, we've literally got thousands of hours of live underwriting that was videotaped that you can set, like my kids when they first started learning to play Mortal Kombat. They get too scared for the next move and they pause. You can pause the underwriting video and say, okay, I don't really get that. I didn't understand. And you can Google the term, or you can go back and look at the sheets that are provided, the rent roll, the T12, the OM, until you figure out what that meant. And then you can start streaming again and start going to the next piece. So it's a wonderful, wonderful, wonderful tool. But then we also have another Thursday night class, which is a lot more of an opportunity for you to test your skill, if you will. So we have a Thursday night call where if you want to put your underwriting to the test, and even for people that know they're still very new at this and they're not very good at it, the Thursday night class is a chance for you to say, okay, this is what I've got so far. Can you guys kind of critique me and critique my underwriting and tell me what I need to do next and why some of my assumptions might be right or wrong? And so those are the two primary things that we do. We've also got a big long-term goal that goes back to my desire to be an open source platform and to be the Wikipedia of commercial real estate. We want to have the #1 underwriting tool, the #1 underwriting space anywhere in the world. And we want to use AI as a big piece of that. So we want, and think of it like this, instead of calling the broker and he gives you a rent row, a T12, and an operating offering, an OM, instead of that, what if he gave you a complete worksheet that already had all that stuff in it? And all you had to do now was determine if the market rents support what's in that underwriting worksheet. And you had to confirm some of the assumptions that were in the worksheet, because that's where real underwriting starts. Up until then, it's mostly data entry. But most of us get so caught up in the data entry, we never get past that. And I'm guilty. You know, I go down every rabbit hole with every cell, and that makes me horrible at underwriting. But if I could just get to the bigger piece and start saying why and start asking those questions, that's the real magic of underwriting. And that's what we want to do. We want to get you to that point as quickly as we possibly can. And we are starting to implement some of those tools. We are partnering with a company that's offering the very first steps, if you will. I don't know if I want to call it steps, maybe crawl. You know, we're starting to crawl, that are starting to implement some of that. And we're going to offer a premium member access for just a few dollars, you know, to help offset the cost of this, because our members have not collectively built this AI themselves, or else there wouldn't be a charge, you know. But we found a company that has built it, and for a small fee, collectively, all of us get to go together and have access to that. So those are the kind of things that we're doing. But I want to wrap up my piece, because I'm very, very excited about the next person that's going to speak. Very proud that that we found each other and connected over Zoom and LinkedIn and the other social medias. And I consider it a great find on my part to have David Monroe of the CCIM Institute, not only on the GOB network, but one of the main drivers of the network. So if you will, please give it up for David Monroe.
All right, guys, we're gonna go ahead and get David set up over here.
You will actually get to see a slide in a minute or two that's going to show you who I am. I know probably about a third of you in here. I did recognize a couple of names on Zoom. Hello, Zoomers. How are you guys? Hopefully you don't get offended by me calling you Zoomers. I've been in training all weekend for CCIM here in Chicago, which is why I'm in this wonderful place right now with these great people. And we had a hybrid, so we had some people on Zoom and we called them Zoomers. They eventually got offended and we started calling them online viewers, but you know, that's the way it goes with instructors. We just tend to do stuff like that. So I want to reiterate one thing before I get started. I know I've only got about 20 minutes, so I had to condense a 45-minute presentation down to 20 minutes, which we'll be able to do. But I want to let you guys know that what Jim said about starting at 10 units instead of 100 units, one of the things that a lot of people don't understand about syndication is that when you go in, and especially when you're first getting started and you are on that sponsorship side, on the GP side, you're not making a whole lot of bunch of money in the beginning. So you'll get a bit of a acquisition fee, and you might get some of the asset management fee through operations. But by the time the preferred return is put in and the LPs are getting paid, and then the, I don't know, 8 to 20 people on the GP side split everything they have to split, which is only their 20 or 30% on that GP side. By the time all that's said and done, you get a whopping $5,000 at the end of the year. Is that really where you want to be? Now, where they do get paid is when the reversion happens or when the sale of the property occurs. That's when they kind of get their payday. You call it a back-end promote. When you're doing 10 units or you're doing 12 units or 14 units and you have 2 or 3 people that can joint venture with you, now we can leave the SEC out of it because it's no longer a syndication. It's just a few people putting some money together to take down an asset. Then you're getting the cash flow. You're not splitting it with 50 other people, and you're not getting a small percentage of it and then splitting even more. So if you are a cash flow investor, you will reach your cash flow goals much faster doing smaller properties than you ever will in syndication. So just keep that in mind. So I just wanted to reiterate exactly what Mr. Biggs said. Okay. All right. So we're going to talk about how to calculate multifamily property. Now, in a physical presentation like this, most of you guys have seen me present online. There's a lot of people in here that have seen me present online. I'm sitting in a chair at my desk, or I'm standing at my desk, and I'm right in front of my computer or my camera. And Julian's moving the slides a little fast, but that's okay. We'll let him. I lost control of sorry, Chris. Lost the control of my clicker. So he's going to take care of that. But normally I'm walking around and I'm working the crowd. I'm not going to be able to do that because I got a camera right in front of me and I got to stand in a single spot. So I was hoping I'd be able to move around a little bit, but I'm not going to be able to. So we're going to try to work this from right here. All right. So you guys want to learn how to calculate current multifamily demand, all right? There is a way to do future. That will be for another day. We don't have time to do future today, so we are just going to talk about current multifamily demand. So what are we going to talk about today? Well, we're going to talk about understanding the current multifamily cycle and how to identify where you are in that multifamily cycle right now. We're going to cover where to find the data. So there are different places you can go that are free and paid to get that data. How to calculate current multifamily demand. And then this says that I'm going to tease you on how to estimate future multifamily demand, but today we're not going to have time to go into that. So cut that one out of it. I didn't have time to update the slide before I brought it here. So it is in the objectives, but we will not be covering that today. Next slide. All right, so a little about me for those that do not know who I am. There are quite a few people in the room here that have no idea who I am and why everybody's giving me all these accolades, and I still can't figure that out either. So when you guys figure that out, let me know. And there's some people online as well that don't know who I am. So I am David Monroe. I'm a CCIM, a Certified Commercial Investment Member. I brought another CCIM with me, Mr. Rick Gonzalez. So the guy sitting in the red shirt right there, I know you Zoomers can't see him. He is in Florida in the Orlando market. So anybody in here that's in the Orlando market, you need to talk to Rick Gonzalez. Okay. I'm a multifamily investor and a strategic partner. I'm very approachable. I'm very personal. You can see you've got my contact information with my phone number, my email address, and everything else about me. So don't ever be afraid to reach out to me. Click. I am a certified CCIM instructor. I don't know if you can see the shirt or not. That's why I'm here in Chicago, is for instructor training. All that means is that out of 13,000 plus CCIM members in the world, there are only 60 instructors. I am one of those. I teach advanced market analysis to students that are working to get their CCIM designation. I am also the Florida VP of Education, talking about Mr. Rick Gonzalez over here in the crowd. I replaced him as VP of Education, and he moved on to the next step. And now he is president-elect for the CCIM Florida chapter. So he is a good person to know. I'm also on the CCIM Tech Board for the next 3 years. Again, I'm on the Foundations Board for the next 3 years. And all those two things mean is that here in Chicago at the CCIM level, I help determine what technology we provide to our Institute members. And on the foundation side, that is our capital raising arm of the Institute for giving out scholarships and things like that. I used to own a property management company, and now I am just a strategic partner, okay? So let's get into the actual crux of the teaching. So how to understand a current multifamily cycle. Go ahead. All right, so if you look at this chart, and normally I can point with a clicker and do different things and kind of show you, so I'm just gonna have to describe this. You have 4 cycles or 4 phases to a cycle. You start in the recovery phase. I know that may not make sense to most people, but we always start our cycle in the recovery phase. So at that very bottom of number 1, that bottom point, consider that about 2009, 2000, almost into 2010. We are sitting at the bottom of that 2008 recession. Okay, as we start to come up now, at that point, we have a lot of vacancy. Rents are low. We may even still be declining a little bit in rents, or they could be stagnant. But as we start to move from 1 to 2, our occupancy starts to go up, so vacancy is decreasing. Rents, although they may still be below the long-term average, they're starting to tick up a little bit. And as we reach that long-term vacancy average or long-term occupancy average line, then by that time, our rents are now high enough where we're starting to get some growth. Our vacancy is decreasing quite a bit at this point, and we continue to move up to that green spot. So on Dr. Muller's cycle charts, which you're going to see here in a minute, that green spot indicates time for new development. So how do we know it's time for new development? Because now our rents have gone up high enough Our NOIs are now strong enough that we can support new development. Until we get to that point, that's why you'll see a rental market for long periods of time where there's no development, but you know that your vacancy sitting at like 3% and you need development. But until the rents reach that level, we can't afford to build. Developers aren't going to go and build for the sake of building. They need it to be able to afford it first. So when that gets to that point, now we start to see construction. So now we've got rents increasing, our occupancies increasing, and now we're working towards that top center point called equilibrium. And even though we've got permits being pulled, construction's happening, deliveries are happening, we get to that equilibrium point. Most developers aren't paying attention. Most investors aren't paying attention. And so they'll continue to pull permits. They'll continue to build. They'll continue to deliver all the way into our phase 3, which is our hyper supply. So now, even though rents may still be increasing a little bit, so in phase 2 and expansion, they were increasing 5, 6, 7, 10. We saw 15% increases at some point through the expansion phase till they get to equilibrium. But now, you know, they're still expanding a little bit on the other side, 3%, 2%, 1%. They're not declining yet. But we're starting to see vacancy ticking up. And because of all those deliveries occurring, that's just a natural process. We're going to see those vacancies increase. Concessions are going to increase again because you're going to give concessions to get people in so we can get that absorption down from a vacant building to an occupied building. That's absorption. And once that occurs, now we can really start to look at the numbers, because remember, now we still have more construction happening. They haven't stopped building yet. Permits are still being pulled. Units are still being delivered. You get to that next point in hyper supply, and that one really starts to tell a tale. So now the market's either going to be sitting there and it's going to say, okay, we can still absorb. So if absorption is keeping up with deliveries, we got a good market. And you go to like CoStar and pull a snapshot report in CoStar, which will give you a really good indication of what that market is doing right at that moment in time. And that's what we're looking at, current. And when you see that, you can say, okay, my vacancy is pretty stable, 3, 4, 5%. My deliveries have occurred over the last 12 months. Let's say they're 1,000, and I've absorbed 800 to 1,000 units. Absorption is keeping up with deliveries, meaning the people coming to the market are renting 800 to 1,000 apartments. Where we delivered 1,000 into the market, they're absorbing. That's a good indication of a stable market. If you're delivering 1,000 units and you're absorbing 2,000 units, that is a strong market. You definitely want to be living there, or investing there would be a better term. If you're delivering 1,000 units, but you're only absorbing over the last 12 months 400 units, 300 units, you can tell the market is starting to slow down. So now you got to dig a little deeper and say, is this going to go in decline? Is it going to stay stagnant? Or are we going to move forward with it? Okay, so all this happens on the hyper supply side. If that market continues to go down, vacancy is going to continue to increase. Rents are going to start to decrease after you get past that middle point in 3. And when you get back below that long-term occupancy average, let's say that long-term average is 8%. So now you're sitting at 10% vacancy. Now we're down in the recession phase. What this doesn't show is from recovery to equilibrium, you have this really kind of slow, long slope. Once you get over the equilibrium line and into hyper supply, it starts to happen a whole lot quicker. So you've got this long, slow up and then a real quick down. That's the way most typical markets have reacted over the last 30 plus years. What we're in right now is not a typical market in any way, shape, or form. So the best way to look at that is do that snapshot and say, okay, do we have a good, strong market right now? If we do, we can definitely go in to do some further investigation. And that's when you go in and do your future analysis, which we'll go into at a later date. Next slide. All right, so this is Dr. Muller's report. As you can see, Dr. Muller is one of the top economists in the country. He is based out of Colorado. He teaches at the University of Denver, and he produces this report every quarter. The latest one out right now is fourth quarter. It just recently came out. I believe this one's third quarter, so I haven't updated my slide yet. We do have a fourth quarter report that just came out a couple of weeks ago, and it is identifying where, in his opinion, from the calculations that he's done, where do the top 50 markets sit on the market cycle right now. You can see that absolutely every one of them are either at equilibrium or in the hypersupply phase, with San Jose being right on the edge of going into recession. All right. Where you see a +1 means that the prior quarter, that market was one step behind where it is now. If you see a -1, I think if you look at that, and I can't see it from here because it's too far from me, I think Denver is a -1 or a -2. I don't remember which. -1. So that means that Dr. Mueller moved it from the previous spot, which was one step further down the road, and moved it back one since the last quarter. I believe in the fourth quarter, there's a bunch of them that have moved back a little bit, and a few have moved a little forward. I don't have the chart up. I haven't even studied it yet, so I can't tell you, but I will get that fourth quarter posted in GOB as soon as I can. Okay, next slide. So I like to have a little fun with this one, and I really can't see this slide very well, but this is a representation of the stock market and how investors react in the stock market and how a market cycle typically happens. Now, again, over the last 12 years, there's nothing typical about what has happened in our market, whether it be real estate or whether it be in the stock market. But you guys can get an idea from this slide. I'm not going to go through it, and I'm a little limited on time anyway, but you can have a lot of fun playing with this. When you look at this, and you can see that it kind of starts down in recovery in the very bottom, goes up to expansion, and then starts to get down into that hypersupply and recession, and then kind of trucks along until it goes back into recovery again. If you look at the very top, where you talk about being in euphoria, where really, if you think about it right now, the stock market, which just yesterday or Friday went back over what, 23 or 35,000 again, whatever it is these days. You know, it's at the highest it's ever been. Investors are in euphoria in the stock market. Multifamily investors, where are you guys sitting right now? You're in euphoria. It's been the greatest thing since sliced bread. Asset values are just going way up over what they should be. And if you've managed to get in time and sell again, you're living a good life right now. But I'll also argue that that next step down in complacency, both the stock market and the real estate market are both sitting in complacency right now. So be careful what you're doing, do your due diligence, and don't get caught up in that euphoria, and be aware of where you are, because that next step past complacency is a big drop off the cliff, and you don't want to be caught with your pants down if you're not paying attention. Next one. All right, so how do we calculate current multifamily demand? All right, so there's a link here. If you guys, can you guys copy that link and put it in the chat for them? So Census Quick Facts, you got a lot of people that'll tell you go to, you know, betterplaces.net or city data. Okay, these are all third-party data sources that source their data from the census. Why not just go to the horse's mouth? Just go direct. Go to Census Quick Facts, and you can easily go to a spot for wherever you're looking. It's either city, county. It won't do MSA level, but it will do the county, city. You can do the USA, and you can benchmark against 4 different locations. And so you can look at and say, okay, I can get my total population. I can get my owner renter ratio. I can get my average household income. I can get all these things from Census Quick Facts. So I don't need to go to these other aggregate websites to get it. I just go right to the horse's mouth. Okay, CoStar, Reese, Yardi, Axiometrics, they're going to provide you with your supply side data. Census will give you your demand, which is people. Demand, write that down for those taking notes. Okay, demand is people. All right, this building, let's take this building for instance. This space is sitting here open, vacant. then the owner, is it Eric? Is that right? Eric is a person, owns a company, needed space to run his business. So that individual that owns that business, demand is people, rented this space. This space is our supply. Okay, so people are demand, inventory is our supply. So CoStar, Reis, Yardi, Axiometrics, Real Capital Analytics, actually going out into the market and surveying it yourself, that's where we get our supply side data. Yes, it costs to get the supply side data. You can say, well, if I go survey the market myself, that's not going to cost anything. I'm going to tell you it's going to cost you more than any of them or all of them all put together, because your time is more valuable than that. And the amount of time that it will take you to do a survey of the entire market, you're better off just paying CoStar $1,400 a month. Trust me on that one. All right, so supply, demand. Where we look down and you see vacancy allowance in there, that is where we're going to get our supply side data. I use CoStar to get that data. All right, your non-household population, you're not going to be able to get that from Census Quick Facts or City Data or bestcities.net or any of those other ones. It just isn't available anywhere. But if you reach out to a CCIM, we have access to what's called Site to Do Business. And Site to Do Business allows us to pull from ESRI, which is the largest demographic aggregator in the world. And we're able to pull that non-household population, which you're going to see in a minute is a little bit important. Maybe not some smaller markets, but in big markets like Chicago, it's going to be very important. Next slide. All right, so how do we calculate current multifamily demand? Well, we're going to pretend that we're going to analyze Monroeville. Okay, David Monroe, we're going to analyze Monroeville. There are Monroevilles all over this country that are real and legitimate. This is a fictitious market. As a matter of fact, I live in Mobile, Alabama. In the county just above Mobile is Washington County. The capital of Washington County just happens to be Monroeville. So when I put this together, I had actually forgotten that. And I've had somebody ask, are you talking about Monroeville in Washington County? I was like, no, this is fictitious. This is my county, okay? Or my city. So this is Monroeville. So we're going to say that in Monroeville, we have a population of 100,000. Next slide. All right. So we then need to go in and subtract out group quarters. So I mentioned you're not going to be able to find group quarters just on the internet. You'll have to get with somebody that's got access to ESRI or some other data source that will give you group quarters. All right. So what are group quarters? Those would be like your prisons, assisted living facilities that are paying for beds that are basically hospitalized. Your military bases, your on-base housing, not off-base housing, on-base housing would be group quarters or non-household population. We don't count those. I said prisons, student housing. On-campus student housing is considered group quarters or non-household population. So we need to subtract them out. That gives us a total household population of 9,000. So what does that mean? Right now, that means we start with 100,000 people. When we subtract out the group quarters, we're at 99,000. So now we have a demand for 99,000 people. How many households do we need for those 99,000 people? Well, if we go back into Census Quick Facts and we look at persons per household, in our case in Monroeville, it tells us we have 2.5 people per household. When I divide my people per household by my 99,000, that gives me occupied housing units of 39,600. Okay, simple division. That doesn't mean that this is how many multifamily units I need. All this is saying is for 100,000 population, we need 39,600 units to occupy those people. That's all that's saying right now. This is just demand. That's homes for sale. That's homes for rent, condos, multifamily apartments, the entire market, right? The next thing we need to know is what is our owner-renter ratio? That's called tenure. Okay, that owner-renter ratio is expressed in a percentage. You go back to Census Quick Facts and it will tell you what the owner-renter ratio is. It's going to tell you what the owner percentage is. We want to get the inverse of that and find out what the renter percentage is. So if it tells you that the owner percentage is 68%, if you do 1 minus 0.68, that will give you 0.32. Or if you do the inverse of 68%, it's 32%, because 100% is what we work off of, right? Simple addition, simple subtraction, multiplication. There's no hard algebra or calculus happening here. Once we know what our renter population is, we then multiply our total demand for the market. We only want to know the renters for multifamily. So when we multiply that out, that gives us a total of 12,672 units. Keep in mind, that's all rental demand. So if you have single family rentals, if you have condo rentals, if you have townhome rentals, apartment rentals, multifamily rentals, your data sources for the supply side like CoStar, Reese, Axiometrics, they're not going to give you the single family data. They're only going to give you the multifamily data. So you're going to have to reach out to a residential broker, which is probably the best resource. Reach out to property management companies that do single family rentals and try to determine in that market what is the single family rental supply for that market that you have just chosen. Okay, in my case would be Monroe. But we're going to say I did that, and the 32% of all rental data is for that market. I don't want to operate my market at 100% occupancy. Do we want a market that's at 100% occupancy? No, because if we get a job, an employer that comes to town, it's going to bring 4,000 employees with it. Where the heck are we going to put the families? Okay, so we never want to be at 100%. That's what that long-term occupancy average is. So when we know what that long-term occupancy average is, we can divide that occupancy back in, or that vacancy back into our data, which is going to give us a larger number than that 12,672. So if 7% is my long-term average, then I just do 1 minus 0.07, that gives me 0.93. So 93% is my occupancy average that I want for this market. So now I just divide my total number of units by 0.93, and that's going to give me a greater number, which says that the number of units that I need to satisfy the rental market in Monroeville is 13,626. Okay, that's the demand side. Really easy. This is super simple to calculate, and you've got access to most of this data already through free resources, and then just reach out to brokers or CCIMs. We get you the rest of it. Next one. So now, is our market in oversupply or not? Okay, this is a demand supply analysis. So demand minus supply equals gap. Notice I said demand supply analysis. No, I'm not dyslexic. I know everybody says supply and demand. Well, I'd like you to take your brain housing groups and switch them around and retrain yourself to say demand supply analysis, because demand minus supply gives you either your gap or your need or your oversupply. Okay, that's very important. It's just a way to remind you how the calculation works. Yeah, you'll get some cross eyes. Well, isn't it supply and demand? Okay, sure, but I like to say it's demand supply. What's the difference? Just inverse. That's all. All right, so if we have our demand, which we already calculated, we know is 13,626 for our market. Go ahead. We then just subtract out the number of units in the market. So this is where you have to go to your residential brokers, your property management companies, and find that single family rental data. And if you have CoStar, you're just going to add that number of units to what CoStar tells you are the current number of units in the markets. They will give you the total units. When you add those two together, in Monroeville, we came out to 14,200. Okay, that means when we subtract demand from supply, we have a negative number. If that number is negative, you're in oversupply. If it is positive, there is a gap. So we have an oversupply of 574 in this market. So if our long-term average is 7%, and we have an additional 574 units that need to be filled before we get back above that long-term line, that means we're probably sitting somewhere around 7.75% to 8.25% vacancy in that market. That's what that tells me. All right. That's it. It is absolutely that simple to calculate your current multifamily demand in any market. I didn't have to go back and look at the last 20 years and see how much population grew in the last 20 years, which really, honestly, doesn't tell me crap. I didn't have to go look in the past to determine what's happening right now. Okay, there are people teaching, I won't mention names, Neil Bawa, that you go all the way back 20 years and you see what the growth is from 20 years ago to when you can pull that data. Well, that data is 2 years ago. It's not even current data. All right. So that doesn't tell you a doggone thing, only that the market grew in the last 20 years. But what's it doing right now? What's that snapshot I can look at and do that demand supply right now? And then there's even a way where we can take this and we can go future based, and I can pull out a crystal ball and use some mathematical calculations and tell you what the future multifamily demand is going to be over the next 12 to 24 months. But we don't have time to go into that right now. So just hit a bunch of times until you get to Q&A. Oh, back one. There you go. Questions. This always spurs a bunch of questions.
Where do you find cap rates?
So cap rates, one thing that Mr. Rick Gonzalez, who's kind of new to multifamily, my buddy here that came with me from CCIM, Mr. Hamad Khan just walked in the door. I'm not a big fan of cap rates, Rick, and everybody that knows me knows I'm not a big fan of cap rates, because cap rates only gives you a snapshot of what's happening right now. And the fact of the matter is, it doesn't matter what the cap rate is. If the numbers work on the property and you can pay your investors what you promised to pay them, and the price point makes sense, what does it matter what the cap rate is? The lender's going to look at it. The appraiser's going to look at it. But if you know your numbers work and you can pay for the property, you might have to raise a little bit of additional capital for it, or you may even save a little bit of capital because they may think that the cap rate should have been lower than what you're getting it for, and they'll give you a little bit more LTV on top of that. So to answer your question on where to find cap rates, CoStar is the best place to go, but you've got to verify the data. Okay, trust but verify. CoStar isn't the greatest thing since sliced bread. But anything under 50 units, there isn't anything else you can use right now. That's where you're going to have to get your data from. Reese, Axiometrics, Yardi, Real Capital Analytics, none of them do anything under 50 units, and they're only in the top 130 markets. CoStar's in every market and will do under 50 units. Again, you've got to verify that data, because the data gets real sparse the lower you get in units and the smaller that market gets. That answer your question, Rick?
Yes.
Thank you, sir.
Well, Rick, how do you calculate your disposition value?
So, yeah, so the question was, how do we calculate our disposition cap rate if we don't care what the market cap rate is? We're going to be looking 3 to 5 years in the future. What today's cap rate is makes no matter to what it's going to be in the future regardless. So what I do is, once I have taken my underwriting and I've done my T3 for my income and I've done my T12 adjusted for me taking over that property, which means I'm going to adjust for property taxes. I'm going to adjust for payroll and management if it requires payroll. I may adjust for a couple of other things depending on what I see when I look at those T12s, but I'll pretty much go with the rest of what's there. That's going to get me to an NOI. Once I've got my NOI, I'm just going to divide that by the price that my model has told me I can pay for the property, because I use net present value. We'll learn about that one later. Once I get that, I'll get what my acquisition cap rate is for this property. I will then ensure that my future cap rate number is going to be at least 50 basis points up to about 200 basis points, depending on what that market's doing. So I'm going to take that demand analysis. One thing about doing a market analysis, demand, supply, and you're going into the future and you're looking at your market. One thing it's going to tell you is whether your market's going to grow or whether your market's going to shrink or whether it'll stay stagnant. Depending on that output. So that's a key there, guys, gals. Your outputs from your market analysis give you your inputs for your financial analysis. A lot of people jump the gun. They go right in and they just start throwing numbers off a pro forma that they got from a broker into a financial model and says, oh, this looks great. Let's throw in an LOI. Hello, people. You just skipped the most important part, and that's doing your market analysis. Market analysis gives you your rent comps, gives you your vacancy average, tells you what your absorption is, tells you what the deliveries are in the marketplace, what your competition is. Until you know these things, you're just throwing a wish and a prayer into a financial model. Okay? You have to know these things first. You can do a quick one to get you to that initial data, but that'll help you build that model. So that'll tell me if for my exit cap, if I know that I got 4,000 jobs coming to the market and I'm going to exit in 3 years, and these jobs are going to start to come to the market between year 3 and year 5, because they got to build that manufacturing plant first, which takes 2 to 3 years to build, then I know I can probably be very aggressive on my cap rate, but still be above my acquisition cap. So at that point, I'll go lowest. I'll go 50 basis points. So I acquire it at a 6.5. I'm going to throw a 7 in my disposition cap rate for my exit value. If the market is stagnant or looks like it's going to decline, there's no new companies coming to the market, which would show a stagnant market, or worse yet, we've got an announcement that a company is leaving, which employs 4,000 people, and I'm going to go down 4,000 jobs. Then I know I need to go to my highest number in my cap rate, or maybe I'm re-examining investing in this market in the first place. But if I decide that I can be the best in the market, meaning I've got the best property, so they're going to come to me first, then, and I'm going to move forward in this market, then I'm probably going to go 2% or 200 basis points higher than my acquisition cap. Does that make sense? Okay, thank you. Front.
What are some of the factors that would drive the recovery? So after the recovery, when it starts growing again, the cycle that you mentioned in the beginning, what are some of the factors that would drive it? Because the buildings that already created the oversupply are still there. People are left. So how would it ever come back from that?
Okay, the question is, how would a market recover if it goes into that hypersupply and recession phase? So that's we're doing that future multifamily demand calculation, doing an economic base analysis. So what we do is we look at the current jobs in the market and we look at future announcements. We can determine from those future announcements, we can put a multiplier to it, and we can take a population employment ratio and give it that. And so it will tell me whether I have new jobs coming and how much housing we're going to need from it, or whether we have jobs leaving. If jobs are leaving and people are leaving and you got new supply coming on the market, that's bad, very bad. That market's going to take a long time to come back. More than likely, those buildings that were under development will probably cease development. If that's happening, they may end up getting sold at foreclosure and somebody come in and do some kind of adaptive reuse because there's just not enough population to fill those units. If it looks like that's occurring, people are moving out of the market and the market's going down, but you're still delivering, but you've got an employer that just announced and is bringing in 4,000 jobs, those developers are going to fight for their life, hold those units as long as they can, probably get a little forbearance from it because the lenders don't want to take it back. They're going to hold it for as long as they can until those jobs start coming, and then it will absorb very quickly from there. So that's how you can identify kind of where that bottom's going to be. So if you're trying to predict where the bottom's going to be, because in investing, when you're looking at that market cycle chart, you want to be investing in the recession phase. You don't want to wait till you're in recovery. If you can be investing in that tick just before the bottom, if you've got the, I'll just say it, if you've got the balls enough to invest at that point, that's where Warren Buffett's investing. That's where Blackstone's investing. Okay, that's where Gray Star is investing. They're investing at that point before the bottom. If you've got the gumption to do that, you will do very, very, very well. You can semi-predict it by doing that future demand analysis. That answer your question? There was somebody in the back.
I just want to get clarification on the population growth. Are you saying not to look at that, or because I'm wondering about the migration?
Okay.
Take a look at the migration coming into the area and where that's coming from.
Okay, the question was, he wanted some clarification. I'm sorry, what's your name? Mike Browski. Wanted to know some clarification on population growth. Why don't I go back 20 years and look at that? Because he's trying to find some migration trends. No.
Not even 20 years, just the last couple of years.
Okay, so he's trying to look for migration habits, try to figure out where migration's coming from. The problem, Mike, is that you're not going to find any data in the last couple of years. And the data that you're getting, so we're getting ready, and I know we've seen teasers from the 2020 census. It actually hasn't been, it may get published this month. Rick, have you been into Site to Do Business this month?
No, I haven't, but when you finish your thought, I want to add.
Okay.
I want to add another piece of information.
Okay, so your data is going to be a couple of years old that you're going to be able to get anyway. So you're not going to be able to kind of see that from that anyway. The best way to look at it is those people are coming to that market for a reason. And it's because a company moved from California to Austin, or they moved from Seattle to Boise, or they moved from New York to Charlotte. So there was a company that moved and their employees followed them, or they had a new hire in the area. Usually it'll be a combination of both. The employees will follow and there will be a big new hire. So by doing the future demand model, not the past, what it did, just remember this: past performance never predicts future results. Where have you guys seen that before? At the bottom of every single one of your financial analysis models tell you past performance does not predict future results. You're told it in your OM, yet you're told to believe the past, okay? The past is great. Lets us know how the market has done up to this point. And there's a point in my training that I do for market analysis that's called Shift Share, where we do look in the past. And when we look in the past, we're looking for certain trends. But what I don't care about is whether 20 years ago, the market was at 100,000 and today it's at 120,000. All that tells me is that it grew from then till now. That's all that tells me. But what I want to know is what's it going to do from now to the future? That's really where our decision process takes us to the next level and separates us from all the rest of the syndicators in the multifamily world that are following Neil Bawa's model. Did that answer your question, Mike? Well, you say.
Well, I think you need a combination of both.
Well, you do, but when you do your shift share,
To see where that market's going.
the past still isn't going to tell you where it's going.
You're right.
It'll tell you why you got there. It just won't tell you where you're going. Yeah. Okay, we're on the same page. Go ahead, Rick.
AC Conway uses U-Haul rental as an indication.
For migration patterns, yes. So the
Very accurate. How many, and I can't remember which data
It's-
source he gets it from,
okay.
but if you look at where the U-Hauls are being left.
So there's
Where the people are going. U-Haul.com.
Well, there's two big data sources. U-Haul may provide it, but they don't give the mapping like these other two. So North American Van Lines is one of them. And what was the other one? Yeah, American Van Lines is one. United Van Lines is the other one. They have great migration maps. They're a year behind. So I think we're now getting the 2020 data on both those websites.
U-Haul's current.
U-Haul will also be 2020, I promise.
Casey's quoting data from last quarter.
Oh, I'll have to check out U-Haul then. But the point is, these moving companies, they will provide migration data where the people are leaving and where they're going. It does it with a color-coded map. It's actually really cool. It'll even give you like not United Band Lines, the other one, just said it. What was it? North American Band Lines. They will give you property tax data and some other data as well as the migration patterns. So if I was doing this webinar online, I'd actually show you guys those resources. I just don't have access to that yet. Yes, sir.
Have you ever seen a market where the rental demand is declining because a lot of people are now choosing to buy instead of rent? And if that is the case, how would you ever tell that it's because of people buying versus people not just being in the market?
So that happens naturally anyway. Typically, when we're looking at leases for apartments, we're looking 1 year into the future. We know, or we try to retain our tenants, but there's always going to be what's called churn. So you're always going to have to turn units. Hopefully, it's a lower percentage than a higher percentage. Normally, it's if you're running a very good community, normally it's because they're moving from renting to owning. We want them to be able to do that. That knowing what your market's doing in the future will be able to tell you whether you can continue to sustain from that. Typically, you're not going to get a recession in any market because of people moving from apartments to households. I've never seen one.
How has COVID affected all of these conversations?
Very little in multifamily. Honestly, very little. We've got some, because a lot of the owners went to forbearance for their loans because they couldn't evict. And that really quickly turned into, if it was agency debt, they couldn't evict. The rest of the owners that didn't have agency debt, if they wanted to evict and the markets would let them evict, they could.
I wasn't coming from that from the eviction standpoint. I was coming from a point where people have learned they don't have to live in the big city to do their job.
So that's why New York City and why San Francisco and some of those other markets, that's why their rents are declining. Now they're on the way back up again because people are starting to move back in. But they did. There were 3 or 4 markets that declined big time. Chicago was not one of them, for those of you that don't know that.
Again, quoting Casey, 28% of people, this age of most people in this room, have told their companies, if you don't let me work from home, I'm going to get a new job.
Right. Right. Which just makes living in apartments even better. Right. But they're also not buying, Rick. They're renting.
Well, I know, that's what I'm saying.
Yeah.
The rental market in the tertiary market and the secondary market have increased.
Yeah, but if you're looking at MSA level, they don't go outside the MSA. They stay within the MSA. It'll affect your trade area, that neighborhood. It just won't affect the MSA.
Your calculation included tenure?
Yes.
Which is the percentage of renters.
Yes.
So is there a sweet spot in terms of the percentage of renters that you see in a given market? We've heard like 33% or a third would be good for the valuation of the property.
Okay,
but
so
is there a zone, a range that is beneficial?
Okay, good question. So the question was, is there a sweet spot or a range for that owner renter ratio, the tenure? And the answer is no. So you just look at it and you do your demand. That's all you do. I've seen really strong multifamily markets that had 20% renter ratio. I've seen really strong markets that had 70% renter ratio. Now those are the two extremes. I saw one at 80% over all the markets I've looked at, but that's very rare, renter ratio. Typically, you're looking somewhere between about 30 and 50%. That's kind of average around the country, but it has nothing to do with the calculations we do. We only use it to determine what are the number of renter units in the market so that we can do our demand calculation. That's all it's there for. Answer your question?
But it also does it affect the class of property?
No.
If it's a higher,
it's
property, it might be lesser.
No. He asked if it affects the class of the property, and no, it does not. All it is a function of demand. That's it. It doesn't take into consideration low income, senior, market rent, class of property. It doesn't take any of that into consideration. All we need to know is what is that percentage so that we can calculate the demand. Because we're looking at total demand. This is for the entire market. This isn't for the trade area. So now when you get down into the trade area, yes, that would make sense. Now you do want to know that information, huh? The neighborhood level, correct. That's exactly right. Yes, well, then it would be a problem. Yeah, good question. Anybody else? Any online questions?
You were answering them as you went.
Ah, okay, good. In the back, yes, ma'am.
So, questions for in Chicago.
Okay.
Have you done an analysis on Chicago? If so, do you remember, do you have an opinion on what you think the future market demand looks like in Chicago?
Okay, so the question was, have I done a demand analysis on Chicago? And if so, can I say what I believe the future demand would be in Chicago? The answer is no, I haven't. I've done some snapshots in time and looked at Chicago and was very surprised at what I saw, but I didn't do any future looking. Chicago right now looks really strong. There does not appear to be any decline. The rents aren't declining right now. As a matter of fact, they're increasing very aggressively, which is a problem for people that live here, but it's not stopping people from renting. So a current snapshot, you're really strong right now. Absorption's keeping up with deliveries. It just shows a real strong market. Yes, ma'am. Anybody else? Well, thank you, everybody. Appreciate the time. Thank you for welcoming me. This has been a blast. Still locking my legs.
All right, guys, we'll give you guys about 10 minutes or so to go ahead and use the restroom, refill your drinks, speak to people right next to you. And then on top of that, those of you guys that are here from out of town, from the GOB, who are interested in coming up and kind of giving us an idea of who you are, where you're from, what kind of value add that you would like to propose, feel free to come up to me and we'll get you out here. You.
Oh, here, Jen.
Yeah, absolutely. So I'll get you tagged.
Oh, sure. Okay, gotcha. All right.
And speak up close.
Sorry. Hey, how's it going, everyone? Thanks for having me. As you mentioned, Frank Latier. I'm from Chicago here, the southwest suburbs, Orland Park, for anyone that knows. I lived down here in River North for about 10 years and just moved back after having kids, having a family and stuff like that. So as you mentioned, I'm with Arrows Capital Group now. Just got my start with them like 7 or 8 months ago. And we are actually taking a very different approach than what Jim and David both kind of suggested. We are looking at bigger properties, 75 units plus, B and C class, value add opportunities, specifically Midwest and like Sunbelt cities. Starting with the market analysis, which I'm also a strategic partner with David Monroe. That program has been tremendous. Highly recommend to anyone here to check that out as well. But we basically start with markets that we, that pass that kind of criteria. We look at, we've developed systems for underwriting. We have a team doing investor relations. We have a team doing marketing. So we kind of have a little bit of everything with that going on. And we actually we closed on our first 45 unit in Northwest Arkansas this last week. Thank you. We have another, we're co-sponsoring with another sponsor on a 296 unit in San Antonio that we have kind of going on right now. And we have a couple other deals that our acquisitions team have sent out LOIs on recently, and we're hoping to get under contract in the next couple of weeks here. So things have been going very well, but as they mentioned, it wasn't a short process. We've been doing this for well over a year, like they mentioned, and it has taken time to get to this point, but been going very good since then. In terms of what we kind of want to bring to the table, it all starts with people on the team. and in the communities that we're going to take over, you know, with these apartment complexes and stuff, just like adding value, making an impact in people's lives. I know the people that I work with at Arrows Capital, we have a really good relationship, have a great time. We all make each other better, push each other, stuff like that. As I mentioned, anyone interested, I know a couple people had mentioned underwriting and stuff like that. We've developed our own somewhat, you know, mostly proprietary kind of software and processes for underwriting and stuff. And I would be happy to talk with anyone who's into that about stuff like that. Same thing with capital raising and investor relations. We have systems and processes in place for doing that. So people that are interested in that or anything, I'd be happy to talk with. And just anyone who is interested in, you know, 75 plus unit, 100 units, like the bigger kind of stuff like that and syndications. Happy to have a conversation with and kind of see where it goes from there. So again, great to be here. Thank you guys very much for having me. Thank you, Jim. Thank you, Chris. Thank you, David. And hope to talk to you guys out there. Best of luck to everyone too. All right. Thank you.
Thank you. Thanks, man. All right, next up, we're going to invite Hamad Khan to come on up here, Mr. Hands-Off Investment.
We're gonna get you on here too.
Talk to us about, kind of share what it is he has to offer.
Yep. There we go. All right, perfect. Hey, my name's Hamad. As you know, Chris mentioned, my business is called Hands Off Investment. You can go check out handsoffinvestment.com. And what my focus is more so is capital raising. So I partner with other GPs, help raise some capital, partner with them, help out with the operations side of things. I've spent the last 15 years in, you know, Fortune 100 companies. And then, yeah, I'm doing this full time now. And if you guys have any questions or want to connect, you know, feel free to come say hi.
Come on, man.
Thanks for the endorsement.
Okay. Oh, where did Pat go? All right, Pat, come on up here. I'm just trying to hide. Yes. Just talk about who you are. No, that's okay. Just talk about just who you are and what it is that you got.
Who am I? Well, I was born. I'm Pat Gage. OpportunityCreator.com is the website. What I provide is market analysis, you know, demographics for your neighborhood, your target markets. I am involved passionately in 188 units, so I do have some capital. But basically, just really, I run a local meetup that meets every other week, and we just kind of mastermind and talk on different topics that are, you know, running around in the commercial multifamily space. And that's it. That's really what I am.
He's the man too. Woo! All right, Misi, come on up here.
Hey, here you go.
Here you go.
This one.
Yeah, you can put this actually just on your shirt. And you can talk.
Okay. Thank you. Hi, everyone. I'm Missy here. Right now, I actually live in Northwest Arkansas. So, Frank, we should connect in a little bit. I used to live in Chicago 4 years ago. So I came here to visit some friends and planned intentionally around this time so I could meet you guys. My company is my Financial Freedom REI. I'm working on rebranding it because the name is really long, but it's a private equity firm, and I'm focused on helping investors gaining financial freedom through investing multifamily in real estate. I also help with the Wednesday capital raising meeting in GOB. So if you're interested in taking more of a capital raising investor relationship role in GOB and in your multifamily journey, you know, we should definitely connect. And you should definitely check out Wednesday meeting. Starting this coming Wednesday, we'll start going over Hunter Thompson's book, Capital Raising in Multifamily. So we'll go over how kind of what he recommends to get started, if that's an area you're interested in. It's always a good skill to have, whether it's in real estate or other areas. So I'm looking forward to connecting with y'all. Thank you.
Andy. All right, where's Andy?
There you go. Come on in.
There you are, Andy. Come on in.
Thank you.
It's a little
surprise, but just introduce yourself. Perfect. Oh, great, thanks. All right, I'm Andy Bentz. I am, okay. It might be cut off with the camera here. I'm Andy Bentz. I am out of Kalamazoo, Michigan. I have a meetup monthly that I bring guests on to talk about different topics. David's going to be this week. He's going to be extending his current demand, the full presentation. You'll see that on Thursday, 7 p.m. 7 p.m. Eastern time. You'll find that at Multifamily Investing Community. That's through meetup.com. My business is Blue Horizon Investments. You can find that under bluehorizoninvest.com. I do want to share with this group, and we can go into this in detail at some point. Maybe I'll do a meetup just on this. This summer, I have brought on 4 unpaid interns for the summer. And some people may be like, oh, you shouldn't do that to these interns because you're not paying them. It's actually, they are seeking this out. And I found that most of these interns that are unpaid are usually they're freshmen and they can't get good positions in companies. So they want, and actually they're the top tier. Some of them, 2 of them are actually valedictorians that are working for me from their high school, and they're very eager to learn and they're very eager to contribute. So I'd highly recommend it. I can go through in detail at some point for the GOB network and tell you kind of how to do that. So you can probably do it next year. That's me. Find me at bluehorizoninvest.com.
Yeah, Mike. Mike, are you still here? Would you like to come on up, introduce yourself?
Hey, Chris, you know, they say the most dangerous person in the room is the one with the microphone, right? I'm Mike Morowski. I'm with My Core Intentions. I'm right here in Chicago. I've been in the real estate space just a couple years less than Jim. So I think between Jim and I, we might know a little bit. So I have a coaching and training business here in Chicago, plus I do some syndications. My whole goal is to give back. How do I give back and teach somebody something that they might not know, something to help them scale their business and grow? I actually wrote a book and published it last year. You can write this down and go download it if you want. It is called Exit Plan, Your Complete Guide to Multifamily Investing and Why You Need an Exit Plan Before You Buy. So it is at mycoreintentions.com/exit plan. And I give that away because I think everybody teaches us how to get in a deal. Nobody teaches us how to get out. Matter of fact, I just read a white paper by somebody who said 25 questions how to vet a sponsor. And the last question was, ask what your exit plan was. And I think it should be done a lot sooner. So glad I was here. Thanks, Chris, and appreciate it.
Derek, you want to come on up? Sure. Introduce yourself.
Well, again, this is completely unprompted and completely unplanned, but thanks, Chris, for inviting me up. My name is Derek Wisner. I'm from Kalamazoo, Michigan, Southwest Michigan. I am a commercial real estate agent. Been an investor for at least 20 years now. Started off with single family properties, own nothing but commercial at this point. Also own and operate a small business. And several commercial assets around maybe a 60-mile radius of my home base, Kalamazoo. I'm a LP in about 6 different deals, 2 here in Kalamazoo, or where are we at? Chicago, 1 in Schaumburg, 1 in Pilsen, Illinois. I am not a sponsor at this point. Not sure if that's a route that I want to go down at this point, but I'm a developer as well. I have 2 different development projects in Kalamazoo right now, a self-storage facility and a mixed-use facility. But for the right deal, I would be interested in partnering as either a JV or whatnot, the right deal in the right market. You can always hit me up, Derek Wisner, and I'd be happy to meet you guys.
All right, I think that's it. Is there anybody else here? Oh, where's Mark? Mark, you want to come on up here?
Mark Rose. She's like, Mark.
Hi, Mark.
Thanks, Chris. Yep. I'm Mark Gross from the Chicago area. I'm with CSSI, which is Cost Segregation Services Incorporated. What we've done is tens of thousands of studies of cost segregation and other tax studies for properties across the country. Even though I'm located here in Chicago, I can provide a no-cost predictive analysis for any property nationwide. And if you're not looking at doing this, you're leaving money on the table because Uncle Sam. I've never run across investors said they think Uncle Sam can spend the money better than they can. So thank you for the opportunity.
Thanks, Mark. All right, anybody else? John, you want to come on up here? Mr. John Manfredi? You want to introduce yourself? Yeah. Yeah, this is your opportunity. Introduce yourself. Oh, and Juan. Yeah, Juan, you can come on up next. No, he's in the middle of talk. All right. Elevator pitch.
We just started this thing. Okay. Just pin this here.
Yeah.
Get this.
That's all.
And what's this for?
Just hold it.
Okay. Hi, I'm John Manfredi. I believe I'm the only architect in the house. Is any architects in here? I guess I'm the only one who saw the light and decided to change from architecture to multifamily investing. I used to design crate and barrel stores and residential projects, senior living, commercial, and I just decided to join the whole multifamily space about 3 months ago. So I'm currently in the Michael Blunt program. Sorry, Dave. And
Be a student, not a follower.
I'm getting the most out of it. But I'm also an instructor here in Chicago. I teach interior designers and architects technology classes. So I'm happy to join the group. And if you need anybody from an architectural standpoint to help you with your projects, come to me. But I'm hoping to find my own properties and build a team, and just happy to be here. Woo. Thanks. Oh, take this.
You want to come up? Yeah, we're calling all you guys out today.
You didn't let anyone plan for this, did you? You're just having fun with this at this point. Anyway, hi guys, my name is Rashid Shah. I am a single family flipper and I've been looking to get into commercial real estate, just starting to learn and grow with all of you guys. My company's name is Recapitome. I just started it not very long ago. So it's spelled as RECAPITOME. Go check it out, and just happy to be here. I'm looking forward to a network with everybody.
All right. Juan Castro, would you like to come on up, introduce yourself here? Let us know who you are and what it is that you do.
Mid-conversation, that was the best one so far. Here you go.
So what I talk about here? Oh, yeah.
Just let us know who you are.
Hey everyone, my name is Juan Castro. Of course. Is that you?
No, you're good.
Hey guys, my name is Juan Castro. Me and my wife Diana, she's in the back. We're real estate investors. We're from the south side. We live around the Midway area. We invest around Marquette, Gage Park, back of the yard, all that stuff. So we started investing at the end of 2018, just bought a property, just put our money somewhere. And then after that, a couple years passed, we bought another property, still just trying to put our money somewhere. Last year, when COVID happened, we had more time to research and to find about real estate. And we figured out that, real estate could be more than just someone to invest. It could be actually a way for freedom. So we started, kind of educating ourselves, opening up, networking, doing all the stuff. We were able to actually double our portfolio last year, and now we're looking into expanding, doing multifamily, just learning more and, try to grow and, hopefully pass it on to our kids. So that's
All right. All right, anybody else who wants to come on up, give their value proposition? If not, we'll go ahead and resume for networking for a little bit.
Brave souls, any brave souls?
Jim Biggs.
Jim Biggs, come on up.
Yep, perfect.
Yes, I just wanted to say thank you for everyone that came. Thank you for the people that had the courage to come up and, well, you didn't really have a choice. I think Chris kind of put you on the spot. But I do want to speak to one thing because this theme seems to be running through the room. There's a lot of people here that are not active investors, and really everything that we've been talking about today is really geared toward active investors, people that are usually what we would say are on the GP side of the team. But none of this would exist without the people that are on the other side, the limited partners, the LPs, the passive investors. And so one of the things that you'll hear over and over and over again is that when you go to a local meetup, you go to a local RIA, that most of the people in the room are never going to buy a house, never going to buy an apartment, are never going to actually do this. And I want to speak to you, if that is you, to say that the fastest, easiest way to become a real estate investor is to invest in one of these deals that the other general partners have. Don't be the person that always wants to be a real estate investor and never actually pulls the trigger because you just are intimidated by the process. If that speaks to you, become a limited partner, become a passive investor. If I had to start over, if I was smart enough 40 years ago when I started this, I would have never created another job for myself. Most of us have full-time jobs. Some of us actually like our full-time job. But all of us can invest as passive investors. You do not have to be an active investor. And as soon as you wrap your head around that and realize that, hey, I can put a money in a deal that Chris has, and Chris did all the work for me. All I have to do is invest once a month. Ask Chris, how are we doing, Chris? I seen the financials, Chris. What's the update, Chris? That doesn't take very much out of your life. An hour a month, maybe 2 hours a month if you are invested in a lot of deals. But it's very, very easy to be a real estate investor. All you have to do is be a passive limited partner. Now, if you want to be active, we are going to provide everything that we can to help you be an active investor. But if you know yourself that you're never going to spend an extra 15 hours a week, 30, 40, 50 hours a week, creating an extra job for yourself, then seriously become educated enough to start investing passively on some of these other deals. And so I don't want you to feel like there's only one path. There's a lot of different opinions in this room. And the one thing that's really wonderful about the GOB network is that we're open to hearing all of them. You know, there is no one right way to do this. And I think it would be extremely arrogant of me or anyone to think that they have all the answers. And that's why we want to be part of a bigger network. I only have a couple of answers, but I know you guys have a lot of answers. And if I stood up here and said, give me 30 grand let me have all the answers, let me be your guru, I don't get it. How arrogant would that be for me to think that I have all the answers? So I really want to say that I'm grateful that we have so many people that are buying into this vision, and they're bringing their expertise, and they're not intimidated. We have several people on our network that are coaches, and they're not intimidated to be on the platform. They know that their business, if they keep providing value, will grow. It doesn't diminish because the GOB network has all these resources, because we all need something, and usually someone, to kind of kick us in the butt and get us going. So there's always going to be room for that space. And so I felt like that was something that I didn't want to leave unsaid, that most of you can and should be investing passively in deals. So I'll leave it at that. Thanks, Chris.
All right, guys. So feel free to go ahead and refill your drinks, network, and we'll keep you guys posted on dinner plans moving forward. Thanks again for coming. And for those of you guys who are on Zoom, thank you guys again for joining us today.